All right, let's jump right in. In this explainer, we're going to demystify some of these core accounting ideas, things like the general ledger, fixed assets, and yep, even taxes. We'll break it all down in a really simple, clear way. I know, it sounds like the start of a really weird joke, doesn't it? But believe it or not, there is a real, solid connection between an office building and a cow. And it's actually a pretty fundamental concept in the business world. The answer is, in the world of accounting, they're all considered fixed assets. So, what does that really mean? Well, basically, these are the big, valuable things a company owns and uses for a long time to, make money. Think about the factory that makes the products or the truck that delivers. Okay, so to really get a handle on why something like a delivery truck is so important on the books, we need to zoom out a bit. We've got to see where it fits into the company's entire financial picture. What you're looking at here is a balance sheet. You can think of it like a financial X-ray of a company, taken on one specific day. On one side, you have assets. That's all the stuff the company owns. On the other side, you've got liabilities and equity. That's everything it owes. And here's the golden rule of accounting. Those two sides always have to be equal. They have to balance. Now, let's zoom in right here. See this line? In Polish, it says rzeczowe aktywa trwałe, which basically means tangible fixed assets. This is exactly where you'd find all those physical things we've been talking about. The buildings, the cars, the equipment. It's their home on the balance sheet. Okay, so we know where these things show up on the financial statements. But what makes something a fixed asset? Like, what are the actual official rules? Let's break it down. Well, it really boils down to a few key criteria. First, it has to be a tangible thing. Something you can actually reach out and touch. The company has to own it, and they have to plan on using it for more than 1 year. And most importantly, they use it to help make money. And this really shows you just how broad the category is. I mean, you've got the stuff you'd expect, right? Buildings, machinery, cars. But then you get down to Group 900, and that's where you find livestock. Yes, farm animals. So now you know how that cow from the beginning fits into all this. So, a company buys all this stuff, but how do they manage it over its lifetime? I think the best way to understand this is to follow the journey of a single asset. Let's imagine the company just bought a brand new delivery van. We're going to follow it from day one all the way to the end of its useful life. You can think of every fixed asset as having a 3-part life cycle. First up is acquisition. That's when the company gets it. Then comes usage, which is the long period where it's being used and, really importantly, losing value over time. We call that amortization. And finally, there's disposal, when it's sold, scrapped, or just taken off the books. Now, if we dive a little deeper into that first stage, acquisition, there are really 3 ways a company can get an asset. They can just buy it. Pretty straightforward. They could also build it themselves, or they might even get it as a donation. And what's super important here is that how you figure out its initial value is different depending on which path it took. Okay, let's talk about that middle stage, usage. This is where the asset is doing its job, day in and day out. And as it's being used, its value goes down. This process is called amortization, or you might hear it called depreciation. And honestly, this is where things start to get, a little tricky, because there's more than one way to look at it. And here it is. This is the big twist. A company literally has to follow 2 completely different sets of rules at the same time. You've got one rule book for its own internal accounting. This tells the story of how the business is actually doing. And then you have a whole other rule book that's just for the tax authorities. It's all about figuring out how much tax to pay. This table just lays that split personality out perfectly. Look at the accounting rules. The company has a ton of flexibility. They get to decide when to start amortizing, which method to use, the rate. It's all based on the asset's real-world useful life. But then you look at the tax laws. Nope, much more rigid. The start date is fixed, you can only use specific methods, and the government sets the rates for you. 2 totally different worlds. Okay, so you've got all this activity, right? Purchases, sales, assets losing value. How in the world does a company keep all of this straight? Where do they write all this stuff down? The answer is something called the general ledger. It's basically the master playbook for all of a company's finances. And it works on a really cool system called double entry bookkeeping. Every single transaction gets recorded in 2 places. For every debit in one account, there has to be an equal credit in another. It's like the law of financial physics. For every action, there's an equal and opposite reaction. And that's what keeps the books perfectly balanced. Let's see how this actually works. On the left, you've got what's called an OT document. This is the official paperwork that says, hey, we just got a new asset. Then, on the right, you see what the accountant does with that information. They translate it into the language of accounting, a series of debits and credits that record the event in the general ledger.
So that OT form is basically the source document. It's the proof. It's got all the key info, what was bought, when it was bought, and for how much. That's the raw data the accountant needs to make the entries in the ledger.
And just like there's a form for the beginning of an asset's life, there's one for the end. So when our delivery van is finally sold or scrapped, this LT form gets filled out. This is the official signal to the accountant, it's time to take this van off our books for good.
So this brings us to the big question, right? Why? Why have two different sets of correct numbers? It sounds kind of crazy. But it's because they're telling two completely different but equally important stories. The first story, the internal accounting one, is for the managers and investors. It gives them the real economic picture of how the business is doing so they can make smart decisions. The second story, the tax one, is for the government. It's a specific calculation just to make sure the company pays the right amount of tax. And if you really want to understand a business, you have to know how to read both of those stories.